They say the global financial system lives inside the borders of nations, shaped by regulations, central banks, and laws. But if you look closely, you'll start to see something unsettling. The real engine of global credit doesn't operate inside any nation at all. It doesn't live onshore. It doesn't belong to any central bank. It has no elected overseer, no public window, no press briefings. It pulses offshore, in places where balance sheets blur, where jurisdiction never lands cleanly, and where money behaves like a shadow, slipping across borders without weight or fingerprints. Have you ever wondered why financial crises seem to appear out of nowhere? Why liquidity suddenly evaporates even when central banks claim everything is stable? Or why the US dollar tightens thousands of miles away from Washington before anyone in America even notices? This is the room you were never supposed to walk into. This is the world of the Eurodollar system. Now the term Eurodollar is a bit misleading. It has nothing to do with the euro currency, and it's not exclusively about Europe. A Eurodollar is simply a US dollar held in a bank account outside of the United States. It could be in London, Tokyo, the Cayman Islands, anywhere. This might sound simple, but this detail is the key to everything. Because these dollars are outside the direct jurisdiction of the U.S. Federal Reserve, they operate under a completely different set of rules, or more accurately, a lack of rules. The Eurodollar system is not a currency. It's not a bank product you can ask for. It's a hidden credit engine built in the cracks of the post-World War II financial architecture. It's a structure so large, so old, and so deeply woven into global markets that even policymakers can only sense its shape in the disturbances it leaves behind. It's the ghost in the machine of global finance. Think about how money is normally created. We're taught that central banks, like the Fed, print money or adjust interest rates to control the money supply. But in the Eurodollar system, money, or rather, credit, is created in a totally different way. It's created not by printing presses or policy decisions, but by belief. It is born from the willingness of one major financial institution to accept another institution as liability as money, even when that liability exists outside of any regulation, supervision, or oversight. Let me break that down. Imagine a bank in London holds US dollars. It can lend those dollars to a corporation in Germany. That German corporation then deposits those dollars into its bank account in Singapore. Now the bank in Singapore sees this new deposit and can lend it out again. Notice what's happening. No physical dollars ever moved from the US. These are all just ledger entries, digital promises passed between banks in this offshore network. Each time a loan is made, the supply of these shadow dollars expands. It's a massive global, interconnected web of interbank lending, all denominated in US dollars, but all happening far from American shores and American regulators. This system grew out of necessity in the 1950s and 60s. The world needed dollars for global trade, but regulations within the US made holding and transacting in dollars expensive. So, banks started doing it offshore, where it was cheaper and faster. This offshore dollar market exploded. It became the primary source of funding for international trade, for multinational corporations, and even for governments. It grew silently, in the background, becoming a system far larger than the domestic U.S. banking system itself. So why does this matter to you? Because this hidden engine is incredibly fragile. Long before a recession appears in the headlines, long before a stock market crashes, the first signs of trouble appear here. A tightening in these invisible offshore books, a hesitation in cross-border lending, a sudden reluctance among institutions that have no one to bail them out. In the domestic system, if a bank gets into trouble, the central bank can step in as the lender of last resort. But in the Eurodollar system, there is no lender of last resort. There's no global central bank to save the day. When the belief that holds this system together flickers, even for a moment, The consequences are immediate and global. The credit engine sputters. Banks stop trusting each other's IOUs. They stop lending. This is what we call a liquidity crisis. The supply of global dollars doesn't just shrink, it vanishes. And when that happens, every nation on earth feels the tremor. Businesses can't get loans to pay their suppliers. Trade grinds to a halt. Financial markets seize up. This isn't a theoretical problem. The 2008 global financial crisis wasn't just about subprime mortgages in the U.S. at its core. It was a catastrophic failure of the Eurodollar system. The offshore credit machine broke down, and the entire world paid the price. Central bankers know about this system, of course, but they don't control it. They can only react to it. When they see the global economy freezing up, they try to flood the world with liquidity through things like dollar swap lines, essentially emergency lending taps to other central banks. But they are always one step behind, trying to patch up a system they can't see or measure accurately. They're fighting a shadow. Tonight, you're not just looking at a chart or a policy briefing. You are standing at the doorway of the hidden engine that moves global credit. The one no textbook admits exists, the one every central bank is quietly terrified of misreading, and the one that can expand or collapse without a single vote being cast. This is not the dollar, you know. This is the dollar that behaves like mist everywhere and nowhere, real and unreal, essential yet unacknowledged. The Eurodollar system is the single largest source of unregulated credit creation in modern history. It expands in silence and it breaks in silence. And almost every major financial crisis of the last half-century began right here in this offshore darkness, long before the public knew anything was wrong. Once you understand this, you start to see the world differently. You understand why the global economy feels so unstable, why crises seem to come from nowhere, and why the official stories from governments and central banks often don't match reality. They're describing the weather on the shore, while the real storm is gathering far out at sea. By understanding the Eurodollar system, you gain a new lens to view the world. You can start to spot the warning signs yourself by looking at indicators that track the health of this offshore system, things like the TED spread, cross-currency basis swaps, or repo market stress. These are the instruments that measure the level of trust and the availability of credit in that shadow world. When they start to go haywire, you know something is wrong under the surface, long before it makes the evening news. This isn't about being a pessimist, it's about being a realist. The world runs on credit, and the vast majority of that credit is created in this unregulated, fragile, offshore dollar system. The story of the money that runs the world isn't what you think. It's not about gold bars in a vault or the U.S. Treasury printing presses. It's a story of a ghost system, a shadow banking network that grew in the cracks of the global financial order right under everyone's noses. This is the story of the Eurodollar. Our tale begins after World War II. The world was in ruins, and the Bretton Woods Agreement was the blueprint for a new, stable financial world. The U.S. dollar was king, pegged to gold at a fixed price. All other currencies were pegged to the dollar. The Federal Reserve was meant to be the steady hand guiding it all. It was a beautiful, orderly plan, but reality is messy. Europe desperately needed dollars to rebuild, far more than the Marshall Plan could provide. The official system couldn't keep up with the soaring global demand, so a clever workaround emerged. European banks started holding dollar deposits, but these deposits were kept outside the United States. They were beyond the reach of the Federal Reserve's rules. They were called Eurodollars. At first, it was just a small technical solution to a practical problem. Think of it as a little financial loophole. But this pool of offshore dollars started to grow. They were dollars in name, but they weren't created in the U.S., they weren't overseen by the U.S., and they weren't backed by any official U.S. guarantee. They were a financial phantom. Then the Cold War threw gasoline on the fire. Soviet-controlled banks were nervous about keeping their dollars in American banks, where the U.S. government could freeze their assets at any moment. So where did they put them? In European banks, of course. They parked their cash in the growing Eurodollar market. Suddenly, this loophole wasn't just a convenience. It was a powerful geopolitical tool, a way to use the dollar without being under America's thumb. But what really made the Eurodollar system explode wasn't politics. It was pure, simple incentives. Greed, if you want to call it that. Back in the U.S., regulations like Regulation Q put a cap on the interest rates that American banks could pay their depositors. So, your money in a New York bank might earn, say, 3%. But over in London, a bank operating in the Eurodollar market had no such restrictions. They could offer 4.5% on the very same dollars. If you were a big multinational corporation in the 1960s, what would you do? The choice was obvious. You'd move your money to where it could earn more. The Eurodollar market became a giant magnet, pulling in dollar deposits from all over the world. And here's the most crucial, mind-bending part, the detail that almost everyone missed at the time. The system wasn't just moving existing U.S. dollars around. It was creating new dollar-denominated credit from scratch. European banks were doing the same thing American banks do: fractional reserve lending. They would take a deposit, keep a small fraction in reserve, and lend the rest out. That loan would then become a new deposit somewhere else, and the process would repeat. They were creating money, but it was all happening offshore, with no Federal Reserve supervision, no reserve requirements, and no safety net. By the late 1960s, the Eurodollar market had swelled to tens of billions. It was big enough to influence global interest rates, yet it was completely invisible on the Federal Reserve's balance sheet. It was a ghost system, operating in parallel to the official one. Policymakers in Washington were getting nervous, but what could they do? These were foreign banks, on foreign soil. They had no jurisdiction. The Eurodollar had found the perfect recipe for explosive growth: higher returns, lighter regulation, and a world hungry for dollar credit. Money had broken free from its geographic chains. Then came the 1970s, a decade that would shake the global financial system to its core. And the Eurodollar was right at the center of the earthquake. In 1971, President Nixon shattered the Bretton Woods system by ending the dollar's convertibility to gold. The final anchor tying money to a physical commodity was gone. From that moment on, the dollar's value was based on one thing only: trust. Trust in the United States, and more importantly, trust in the vast network of dollar-based financial instruments circulating around the globe, the Eurodollar system. With the gold link gone, the Eurodollar market went into hyperdrive. It became the main highway for financing international trade. Then came the 1973 oil crisis. Oil-producing nations were suddenly flooded with unprecedented amounts of cash, so-called petrodollars. Where did they put all this money? You guessed it. They deposited their massive surpluses in the Eurodollar banks. These banks then took that money and lent it out to developing nations across Asia, Africa, and Latin America, countries that were desperate for capital to build their economies. This created a massive global recycling loop. Petrodollars flowed into European banks, which then channeled those funds into international loans. The Eurodollar system wasn't just a sideshow anymore. It had become the beating heart of global credit creation. It was financing governments, building industries, and shaping the destinies of nations, all while operating in the shadows of the formal monetary system. This shadow system, born from a simple loophole, had grown into a global leviathan. It was more flexible, more efficient, and more profitable than the official system. But it was also more fragile. With no central bank to act as a lender of last resort, no deposit insurance, and no unified regulatory body, the whole structure was built on a foundation of trust and short-term credit. It was a chain of promises, with each link depending on the next. As long as the money kept flowing and everyone believed the promises would be kept, the system worked beautifully. But what would happen if that trust ever faltered? What would happen if a single link in that chain were to break? The world was about to find out, as the offshore dollar system set the stage for the financial crises of the decades to come. But every incentive that made this system so powerful also made it incredibly fragile. By the early 1980s, the world got a taste of this fragility. The United States was battling runaway inflation, and the Federal Reserve, led by Paul Volcker, decided to take aggressive action. They jacked up interest rates. Now, for the average person in America, this meant more expensive mortgages and car loans. But for countries and companies around the world who had borrowed billions of these offshore Eurodollars, it was a catastrophe. Suddenly, their loan repayments skyrocketed. This wasn't some abstract economic theory. It had real-world consequences. The Latin American debt crisis of 1982, for instance, wasn't just a regional problem. It was a direct result of this offshore dollar system. Countries had borrowed more money than they could ever hope to repay when interest rates spiked. The Eurodollar system had grown so big, so interconnected, that when its borrowers started to default, the entire global economy felt the tremors. It was the first major warning that this shadow banking system had the power to destabilize the world. As we moved into the 1990s, the Eurodollar system wasn't a shadow anymore. It had become the core operating system for global finance. Think about it like this. The official, regulated banking system was like the user interface on your computer, what you see and interact with. But the Eurodollar system was the deep underlying code that actually made everything run. Global banks expanded, lending across borders became the norm, and incredibly complex financial products like derivatives, all tied to offshore dollar interest rates like LIBOR, exploded in popularity. The system's tentacles were now reaching into every corner of the financial world. Then came the Asian financial crisis of 1997. We often hear this story as one about countries with weak currencies getting attacked by speculators. And that's part of it. But it was also fundamentally a Eurodollar story. Entire nations in Asia had built their economies on a steady diet of cheap offshore dollar loans. When global financial conditions tightened and that flow of dollars suddenly dried up, their economies imploded. It was a classic liquidity crisis. The money simply vanished. Here's the terrifying part. The U.S. Federal Reserve, the institution supposedly in charge of the dollar, couldn't directly step in. These loans and liabilities were technically outside its jurisdiction. They weren't made in New York. They were made in London, Tokyo, and Singapore. And yet, the fallout was so severe that it required a massive coordinated global response to prevent a complete meltdown. The world was beginning to see the dangerous paradox of the Eurodollar system, a global dollar empire with no emperor. If the 1980s and 90s were warning shots, the 2008 global financial crisis was the full-scale explosion. This is where the deepest, most terrifying flaw of the Eurodollar system was laid bare for all to see. The crisis started in the U.S. subprime mortgage market, but it didn't stay there. It quickly mutated into a global dollar funding crisis. Why? Because the entire world was running on Eurodollars. When complex mortgage-backed securities in the U.S. started to fail, trust evaporated overnight. Banks, which had been happily lending dollars to each other in the offshore market, suddenly slammed the brakes. No one knew who was solvent and who was holding worthless assets. Banks across Europe, from Germany to the UK, found themselves in a desperate situation. They had massive short-term dollar debts that they needed to roll over every single day. But now, no one would lend to them. The global dollar funding market froze solid. This was the moment the system broke. The lenders who had once treated offshore dollar credit as if it were real money suddenly realized it was just a promise, and they started to question if that promise would be kept. The result was pure chaos. This triggered a financial tsunami that required the most extraordinary intervention in history. And who had to step in? The U.S. Federal Reserve. The irony was staggering. The Fed, which had no regulatory power over this offshore system, was forced to become its lender of last resort to save the entire global economy. They unleashed unprecedented measures. They opened up dollar swap lines with foreign central banks, essentially shipping pallets of digital dollars overseas. They created emergency lending programs and pumped trillions of dollars of liquidity into the financial system. The institution that didn't create the problem had to invent a solution on the fly, because the alternative was a complete economic apocalypse. The 2008 crisis proved, without a doubt, that the offshore Eurodollar system was too big to fail and too interconnected to be ignored. After the dust settled from 2008, you might think regulators would have tamed this beast. But the Eurodollar system didn't disappear, it just evolved. Throughout the 2010s and into the 2020s, it became even more deeply intertwined with what we call global shadow banking. Think of things like cross-currency basis swaps and offshore repo markets complex, obscure mechanisms that are all part of this vast, unregulated world of dollar creation. Even major geopolitical players couldn't escape it. China, for all its efforts to build alternative payment systems and promote its own currency, remained heavily dependent on offshore dollar liquidity to fuel its global trade and investment. European banks, despite facing a wave of new regulations after 2008, still held enormous offshore dollar positions on their balance sheets. The system was just too essential to quit. And every time financial stress appeared in the world in 2011 during the European sovereign debt crisis, in 2014, in 2018, and again during the market panic of March 2020, where did the first warning signs flash red? Not in the United States. They surfaced in the offshore dollar markets. The system had become the world's single largest source of unsecured, unregulated dollar credit. It expands and contracts not based on decisions made in Washington, but on a complex web of incentives that are almost invisible to the public and completely beyond the direct control of any single government. We still talk about the Federal Reserve as if it's the all-powerful master of the global dollar system, turning the dial on global liquidity. But insiders, the people who work deep within the plumbing of global finance, they know the truth. The real leverage point, the real power center, is offshore. It's in the balance sheets of global banks that create dollar liabilities out of thin air, without ever needing a single transaction to pass through the United States. This is the hidden origin of the mechanism that underpins everything in our modern financial world. This is the Eurodollar Credit Creation Engine. It's an offshore architecture that built a parallel monetary universe, operating in silence, shaping every market, every crisis, and every boom and bust cycle we experience. Everything that follows every financial shock, every period of tightening credit, every market panic starts right here. It starts with how this engine creates dollar credit in a world where no central bank has authority, no voter has a say, and no single institution has a full picture of what's going on. For a long time, everyone, including the experts, thought the Eurodollar system was just a sidekick to the U.S. financial system. Imagine a vast ocean of U.S. dollars held in banks outside of America. The idea was that this offshore market was like a moon orbiting the Earth being the U.S. Federal Reserve. The Fed would set interest rates, and the offshore dollars would just fall in line. It made sense, right? The system was dependent on the good old American dollar, anchored by the strength of the U.S. economy. But that assumption was wrong, dangerously wrong. While everyone was looking the other way, especially after the 2008 financial crisis, something fundamental shifted. The Eurodollar system wasn't just growing. It was evolving. It transformed from a simple lending system into a mind-bogglingly complex web of financial promises. Think of it less like a bank vault and more like a network of IOUs, all resting on one fragile thing: confidence. The stability of this massive multi-trillion-dollar system no longer came from the U.S. government's backing. It came from the collective belief among global banks that everyone else in the network would be able to pay their debts tomorrow morning. And here's the scary part. You can't regulate belief. You can't put a number on confidence. This is where the story flips on its head. The Eurodollar system, once the follower, became the leader. The tail started wagging the dog. Instead of the U.S. Federal Reserve setting the tone for global dollar liquidity, the offshore system began dictating the terms. When this hidden network felt stress, when it became harder for international banks to get the dollars they needed, the pressure did unstay offshore. It boomeranged right back to the United States, threatening to destabilize America's own financial markets. We saw the first major sign of this in 2011 during the European debt crisis. Suddenly, there was a massive dollar shortage in Europe. This wasn't just Europe's problem. The stress quickly spread, and U.S. money markets started to wobble. What did the Federal Reserve do? They didn't tighten their grip. They couldn't. Instead, they had to open up emergency swap lines, essentially pumping dollars into the offshore system to keep it from collapsing. It was a quiet admission of a startling new reality. The Eurodollar system had grown so big and so interconnected that the U.S. had no choice but to bail it out. For the first time, the Fed wasn't controlling global dollar liquidity. It was chasing it, trying to plug leaks in a ship it didn't build and couldn't steer. But the plot thickened even more in the late 2010s. The Eurodollar system started acting weird. It began behaving in ways that no economic model could predict. Pressured by new regulations and other internal constraints, this global money machine started sputtering. It would pump out huge amounts of credit for months, fueling markets, and then, with no warning, it would slam on the brakes. No major news event, no announcement from a central bank, just an abrupt tightening that would send shockwaves around the world. Think about some of the strange market moves we saw. The sudden surge in the dollar's value in 2014, the bizarre funding stresses in 2018, the infamous repo market freeze in 2019. These weren't random events. They were symptoms. They were signals that the Eurodollar engine had decoupled from the traditional economic cycle. Offshore banks weren't responding to the Federal Reserve's interest rate decisions anymore. They were responding to their own internal plumbing, things like collateral availability, regulatory pressures, and their own appetite for risk. These are factors completely invisible to the public and, for the most part, to policymakers themselves. The world was watching the Fed, but the real action was happening backstage inside the balance sheets of a global network of shadow banks. Then came March 2020. As the pandemic hit and fear gripped the world, the moment of truth arrived. The offshore dollar system didn't just stumble. It seized up completely. It had a heart attack. Institutions that were thought to be the bedrock of global finance suddenly stopped lending dollars to anyone. The entire system froze. The response was unprecedented. The Federal Reserve and other central banks had to launch the biggest financial rescue operation in history, opening dollar swap lines on a scale that dwarfed even the 2008 crisis. And here is the ultimate revelation. The big story wasn't that the system needed a bailout. The big story was that without that bailout, global trade and finance would have utterly collapsed within days. The offshore dollar world had grown so enormous that only the Federal Reserve, the one institution that had no hand in creating it, had the power to save it. By stepping in as the lender of last resort to a system, it doesn't even regulate the Fed unintentionally confirmed a secret that had been whispered in the halls of finance for years. The true center of global dollar creation wasn't in Washington, D.C. anymore. It was in the shadowy, unregulated, offshore network. This was the quiet revolution that changed everything. Monetary power had shifted irreversibly from governments and central banks to an invisible, borderless network with no rules and no safety net. We all still operate under the illusion that the Federal Reserve is in the driver's seat of the global economy, but the mechanics tell a different story. Global markets move when these offshore balance sheets expand. They freeze when these balance sheets contract. The United States, the issuer of the world's reserve currency, found itself in the bizarre position of being both a master and a servant to a system that lives beyond its control. So what really changed wasn't just the size of the Eurodollar market. It was the very nature of money itself. Onshore, in the U.S., dollars still listen to policy. The Fed raises rates and the economy reacts. But offshore, dollars don't listen to policy. They listen to incentives. And the incentives of this global shadow banking system can change in a heartbeat without any warning. This is the final, chilling twist. The Eurodollar engine isn't just a system for creating credit. It's the system that controls the breathing of the global economy. When it inhales, liquidity floods the world and asset prices soar. When it exhales, markets tighten and economies struggle long before any headline gives you a clue what's happening. The global financial system has a machine like this at its core. The Eurodollar Credit Engine. It's an offshore, unregulated system for creating U.S. dollars, and its true scale and fragility only become visible during moments of crisis. Every major financial shock of the past 50 years has peeled back another layer of this hidden architecture. To really grasp how this engine drives the world, we can't look at the calm periods. We have to follow the moments of stress when the system contracts, collateral vanishes, and rolling over dollar debt becomes a desperate scramble for survival. Our first stop is the 1997 Asian financial crisis. Today, we remember it as a story of currency pegs, speculative attacks, and crony capitalism. But beneath the surface, it was fundamentally a crisis of offshore dollar mismatches. Throughout the mid-1990s, emerging economies in Asia were on a tear. To fuel their rapid growth, they borrowed heavily, not from American banks, but in the Eurodollar market. These were short-term U.S. dollar loans created and traded entirely outside the United States. Think about that countries like Thailand, Indonesia, and South Korea were funding long-term, multi-year infrastructure projects and factories using short-term, offshore dollar debt. By 1996, data from the Bank for International Settlements, or BIS, shows that foreign banks held over $600 billion in claims on these Asian economies. Meanwhile, the official foreign currency reserves of these nations were just a tiny fraction of that amount. The entire system was built on a massive mismatch. Offshore lenders were funding themselves with short-term liabilities, and the Asian borrowers were using those funds for long-term projects. It was a classic case of borrowing short to lend long, but on a global scale and in a currency they couldn't print. So, what happened when the tide went out? When global liquidity tightened and investors started getting nervous about political stability in the region, the music stopped. The offshore lenders who had been so eager to provide credit suddenly refused to roll over the maturing dollar loans. The rollover rate for the short-term debt just collapsed. One day you could get a loan. The next day, the window was slammed shut. Suddenly, the banking systems in Thailand, Indonesia, and South Korea were starved of the dollars they desperately needed to function. The results were catastrophic. The Thai baht collapsed in July 1997. Within 6 months, Indonesia's currency, the rupiah, had lost over 80% of its value. Even South Korea, an industrial powerhouse, was brought to its knees, forced into a massive $58 billion bailout from the IMF. Now, here is the crucial part. This wasn't caused by the Federal Reserve raising interest rates or by American banks pulling back their lending from inside the U.S. The entire crisis was triggered by the contraction of offshore balance sheets. The Eurodollar Credit Engine, this massive unregulated system, simply seized up, leaving entire economies stranded with no lender of last resort. It was the first clear global warning sign of how fragile this offshore dollar world truly was. But the most revealing crisis, the one that showed the world the terrifying power of the Eurodollar engine, came in 2008. The story we all know is about subprime mortgages in the U.S., but while the public was focused on housing, something far more dangerous was happening in the wholesale money markets. It was an offshore dollar funding run on a scale that was previously unimaginable. By 2007, according to the BIS, non-U.S. banks had piled up over $10.7 trillion in U.S. dollar liabilities. Let me repeat that, $10.7 trillion. The vast majority of this was short-term debt created and held offshore. For context, the entire balance sheet of the U.S. Federal Reserve at the time was only around $800 billion. This meant the offshore system had created a mountain of dollar IOUs more than 10 times larger than what the official U.S. banking system could possibly backstop. It was a shadow financial system operating in plain sight, and it was about to have its Lehman moment. When Lehman Brothers collapsed, confidence in the global banking system evaporated overnight. Lenders in the Eurodollar market, who had been freely lending to each other just days before, slammed their wallets shut. They refused to roll over short-term funding to anyone because no one knew who was solvent. We can see this breakdown in the data. The LIBOR spread, a key indicator of stress in the interbank market, exploded. This spread measures the difference between what banks charge each other for loans and the risk-free interest rate. Normally, it's just a few basis points. In the weeks after Lehman, it blew out from around 10 basis points to over 360. This was a 5-alarm fire. It signaled a complete and total breakdown of trust. European banks, particularly in the UK and Switzerland, were at the epicenter of this storm. They had enormous offshore dollar books but very limited access to actual U.S. dollar liquidity. Funding spreads for giants like UBS and Deutsche Bank went through the roof. Back in the U.S., money market funds, which were a key source of this offshore funding, got spooked. Fearing they were lending to banks that were about to fail, they yanked over $300 billion from funds that held European bank debt in a matter of days. The Eurodollar Credit Creation Engine didn't just slow down. It went into a violent, full-scale reverse. Offshore credit was being destroyed faster than anyone could track. This is where the Federal Reserve faced a paradox. The crisis was happening in offshore dollar liabilities that it didn't regulate and had no official authority over. But if it did nothing, the entire global system of trade, investment, and banking would collapse, taking the U.S. economy with it. So, it was forced to act. In December 2008, the Fed opened unlimited swap lines with major central banks around the world. This allowed institutions like the European Central Bank and the Bank of England to borrow dollars from the Fed, using their own currencies as collateral, and then lend those dollars to their desperate local banks. At the peak of the crisis, foreign central banks drew over $583 billion from these swap lines. The Fed was forced to become the lender of last resort to the entire world, effectively rebuilding an emergency version of the offshore market that had just imploded. This was the moment everyone on the inside realized the Eurodollar system wasn't just big. It was essential. And it wasn't just essential. It was fundamentally uncontrollable. The Fed's intervention didn't fix the engine. It just hot-wired it to get it running again. After 2008, the engine didn't go away. It evolved. New regulations like Basel III were designed to make banks safer by forcing them to hold more high-quality liquid assets, which in practice mostly meant U.S. Treasury bonds. This had an unintended consequence. It changed the mechanics of how offshore dollar lending worked. Repo markets, where institutions lend to each other using securities like treasuries as collateral, became much more central to Eurodollar funding. This meant the creation of offshore credit was now tied directly to the availability of safe collateral, especially U.S. treasuries. And this created a new vulnerability, one that became painfully clear in 2011 during the European sovereign debt crisis. As investors lost confidence in the government bonds of countries like Greece, Italy, and Spain, European banks holding those bonds faced a problem. The value of their collateral was plunging, and they were being forced to post more of it to back their loans. To raise cash, especially U.S. dollars, they were forced to sell one of the few pristine assets they had left, U.S. treasuries. Now, you might think a big sale of treasuries would cause their prices to fall and yields to rise. But the opposite happened. Treasury yields fell sharply. This wasn't a classic flight to safety. It was a desperate scramble for U.S. dollar liquidity by offshore institutions. The stress was visible in another key market indicator, the cross-currency basis swap. This basically measures the cost of swapping a currency like the euro or yen into U.S. dollars. In normal times, this cost is close to zero. But in November 2011, the cost to swap euros for dollars plunged to negative 150 basis points. This was a clear signal of extreme dollar funding stress. It was far more expensive to get dollars than theory suggested it should be. And what happened next? You guessed it. The Federal Reserve, once again, was forced to step in. It reopened the dollar swap lines, which peaked at nearly $109 billion as European banks scrambled for funding. In 2018, the Fed was tightening its policy, raising interest rates and shrinking its balance sheet. You'd expect things to cool down, but offshore, the opposite was happening. Dollar debts had ballooned faster than reserves, and the global demand for dollar credit was outstripping supply. This created a serious squeeze. We saw this in something called the cross-currency basis. For big players like Japanese banks, which are huge lenders of offshore dollars, this basis plunged. In simple terms, the cost to borrow dollars outside the U.S. was skyrocketing, even though there was no obvious crisis. This was a critical turning point. The Eurodollar engine was no longer just reacting to major risk events. It was sputtering because of deep, structural imbalances building up within bank balance sheets. Then came September 2019. This event still confuses the public, but for insiders, it was a terrifying moment of clarity. The repo market, which is like the plumbing for short-term funding using super safe assets like U.S. treasuries, went completely haywire. Repo rates, the interest rate for these overnight loans, suddenly spiked from a calm 2% to nearly 10%. Why? The immediate reason was that the big banks, the dealers, were unable or unwilling to handle all the treasury collateral. Their balance sheets were too constrained. But the deeper signal was coming from the Eurodollar system. It was screaming that offshore funding channels had become so clogged that even the world's safest asset, U.S. treasuries, couldn't be financed smoothly. The New York Fed had to jump in, injecting over $75 billion in a single night, and hundreds of billions more in the following weeks, just to stop the system from seizing up. But this was just a band-aid. The real problem was that the offshore dollar creation machine was strained, high-quality collateral was getting scarce, and years of new regulations had limited the bank's ability to act as shock absorbers. The engine wasn't just failing. It was overheating from its own internal complexity. And all of this was just a dress rehearsal. It was the prelude to the main event, the massive global shock of March 2020. When the pandemic hit and markets went into a freefall, everyone, from foreign central banks to global corporations, scrambled for one thing: U.S. dollars. The demand was desperate and overwhelming. Dollar funding costs exploded. The TED spread, a key gauge of fear in the banking system, shot up. Once again, the Fed had to step in, reopening its emergency swap lines with other central banks on an unlimited basis. Foreign banks borrowed over $450 billion in just a few weeks. But here's the most shocking part. The U.S. Treasury market itself broke. This is the bedrock of the entire global financial system. In a panic, everyone is supposed to rush into treasuries, pushing their prices up and yields down. But for a moment, the opposite happened. Yields actually spiked. Why? Because the plumbing was broken. When offshore dollar funding disappears, even U.S. treasuries can't function as a safe asset. People who own them couldn't sell them for cash. This was the ultimate proof of how the Eurodollar engine has rewired global finance. The Fed wasn't just trying to stimulate the economy with its massive rescue programs. Its first job was to fix the broken plumbing of the offshore dollar credit system. This brings us to the core truth. The Eurodollar system isn't some small extension of the Fed's world. It's a parallel universe. It's a universe of dollar liabilities created entirely offshore through bank balance sheet expansion, complex collateral chains, and derivative deals. It has no direct oversight, no reserve requirements, and no built-in circuit breaker. The numbers are staggering. As of 2022, non-U.S. borrowers held over $12 trillion in dollar-denominated debt, much of it tied to this system. Global banks held $18 trillion in dollar claims and liabilities outside the United States. These figures absolutely dwarf the Fed's ability to act as a backstop. The offshore system isn't just large, it is the main source of global dollar credit. And that is why every crisis seems to begin offshore. Here's how the cycle works. During good times, when everyone is optimistic, Eurodollar credit creation goes into overdrive. Banks aggressively expand their balance sheets, lending dollars they don't physically have. This floods the world with liquidity, making it cheap to borrow. But when the mood shifts, when risk appetite fades, when collateral becomes scarce, the process violently reverses. These offshore balance sheets contract, sucking liquidity out of the system and sending shockwaves across the globe. Think about it. The Asian financial crisis, the 2008 collapse, the 2011 European debt panic, the 2018 funding stress, the 2019 repo spike, and the 2020 liquidity freeze. They all share the same origin story. A squeeze in the Eurodollar engine that happens before the public even knows there is a problem. The mechanics are almost deceptively simple. Offshore banks create dollar liabilities by making loans or buying dollar assets. None of this involves moving physical U.S. dollars. It's all just accounting entries, creating claims denominated in dollars. In good times, these liabilities are invisible and nobody cares. But when risk spikes, everyone suddenly demands real dollar liquidity or real, high-quality dollar collateral to back up those claims. And that's the one thing the offshore system cannot create on its own. This mismatch is why crises seem to erupt out of nowhere. The system works fine until it doesn't. And since nobody regulates the creation of these offshore dollar liabilities, the only institution that can step in to stop a global meltdown is the Federal Reserve. The Fed is constantly forced to rescue a financial universe that it does not control, does not supervise, and did not authorize. In this sense, the Eurodollar Credit Creation Engine acts like an unregulated monetary superpower. It expands global liquidity when banks feel confident and profitable. It withdraws global liquidity when banks feel fear and pull back. It, not the Fed, often determines the real-world price of the dollar through these offshore balance sheet dynamics. And when it breaks, the world breaks with it, because the entire global financial architecture is built on this shaky foundation of offshore dollar promises. It's a system designed for booms, but dangerously unprepared for the inevitable busts, leaving the rest of us to deal with the consequences. The most important lesson of the Eurodollar system isn't how it grew, or even how it breaks. The deepest truth is that the world depends on a financial architecture that was never designed, never approved, and never fully understood by the very institutions now forced to keep it stable. Think of it like this. A massive credit creation engine is humming quietly beneath the entire global economy. This engine, the Eurodollar system, creates US dollars without permission and withdraws them without warning. It shapes the fate of nations with fluctuations that are completely invisible to the public eye. Policymakers and news anchors still talk as if the Federal Reserve is in complete control of the global money supply. But the financial crises of the last 50 years have revealed a very different reality. A stark asymmetry exists. These offshore balance sheets, scattered across the globe, create the dangerous conditions, and the Fed is just left to clean up the mess. That is the heavy burden of our modern world. We have a global reserve currency, the US dollar, issued by one nation, but it's being multiplied and expanded by hundreds of other institutions in places where no government, no regulator, and no law has any real jurisdiction. We've built our entire financial civilization on top of a shadow foundation. And that structure only holds as long as confidence holds. The warning is quiet, but it's unmistakable. Every single time this Eurodollar engine contracts, the global system enters a phase of uncertainty that no central bank can prevent. When these offshore institutions get scared and pull back, credit vanishes in places far from the headlines. It disappears from corporate loans stretching across continents, from the funding that governments rely on, and from the trade finance lines that allow physical goods to move from one country to another. The impact isn't theoretical. It's immediate, it's real, and it's deeply structural. A little tightening in Tokyo can become a full-blown currency collapse in Jakarta. A funding shortage in London can trigger a liquidity crisis in São Paulo. A collateral squeeze in Zurich can cause the U.S. Treasury market in New York to seize up. The world feels these tremors long before anyone can identify where they came from. Why? Because the engine creating these shocks operates in the shadows, on balance sheets that no one ever sees until they fail. And with each cycle of boom and bust, the bind gets tighter. The more the global economy comes to rely on these offshore dollars, the higher the stakes become when those dollars suddenly vanish. Here is the secret that insiders whisper but never say out loud. The Eurodollar system has no natural endpoint. It doesn't slowly evolve toward stability or mature into a safer system. It just grows in waves of optimism and then violently contracts in moments of fear. It expands global liquidity with zero oversight and then withdraws it with zero warning. And because this system has no official lender of last resort, no capital requirements, no circuit breakers, every single contraction has the potential to become a catastrophic systemic fracture unless the U.S. Federal Reserve steps in to stop it. This is the great paradox at the heart of modern finance. The institution that does not control the system is the only one capable of saving it. The Fed doesn't act because it wants to. It acts because it has to. The only alternative is a complete global meltdown. And every time the Fed intervenes, every time it provides swap lines, repo facilities, and emergency liquidity, it just reinforces the system's dependence on these ad hoc backstops that were never part of the original design. It makes the next crisis even bigger. So the final warning isn't about a specific crisis or a specific country. It's about the architecture itself. As long as the Eurodollar engine exists in its current form, the entire world will remain vulnerable to sudden dollar shortages, hidden funding fractures, and liquidity shocks that emerge from the shadows, far from public view. Policymakers can debate reforms. Nations can explore alternatives like central bank digital currencies, and institutions can try to build safeguards. But none of these efforts change the fundamental dynamic. Global finance runs on a currency that is created in two separate realms. One is regulated and visible, the other is not. One is onshore, the other is hidden offshore. Until the world confronts the reality that its greatest financial power is also its greatest source of fragility, crises will continue to begin where they always have, offshore in the shadows and the quiet spaces between balance sheets where the first cracks appear long before anyone sees the surface breaking. The story doesn't end with a neat conclusion. It ends with a crucial understanding. The Eurodollar system will shape every future crisis, just as it has shaped every crisis behind us. But now, if you know where to look, and you do, you will see the signs of the next contraction, long before the rest of the world realizes what is coming.